Hello, Bull Profits Nation. Welcome to Market Talk Monday on the Paul Mampilly YouTube channel. I'm Amber Lancaster. Thank you for tuning in this week. As you can see, Paul is joining us today to discuss current market conditions, some really pertinent information we recently saw in a Cathie Wood interview that really, I say, just confirms our stance as a Bull Profits Nation America 2.0 focused investors, and of course answer some hot topic market questions. So great to see you, Paul. Thank you for being here today.
Thanks for having me on again, Amber. It's a historic time with what is going on with Russia and Ukraine, and our prayers and our hearts go out to all the folks that are being affected. But it is a historic time, really. I mean, I have to say that I've been through many historic times. I remember being around when the Berlin Wall fell. That was at the very beginning of my career, and I can recall that period of time. That came shortly, around also the original Gulf War, and there were a series of events around, when Russia went bankrupt. There were market events, there were other wars. So, I mean, I put this out in a tweet. In our business, there's no vacations, there's no breaks, there is always something.
Yes.
There is always something, and that is where we are today. Of course, some of the images that we're seeing, truthfully, are incredibly heartbreaking, truly heartbreaking, and our hearts go out to all the folks that are affected. However, I've told folks that for our channel, we're going to leave foreign policy and all of those other discussions for other people to focus on. And we're going to focus on what we know is important for you. And that may seem selfish, may seem wrong. Nonetheless, that's what we believe, how we can be of the greatest service to you. And so that's what's going to be the focus, even though we do want to say we are aware of what is going on, we acknowledge what's going on, but we are going to try and continue to do our work for you. Yes. All right, Amber, with that, I gave you some license to go and be the representative for our subscribers and say, hey, Amber, if you were a subscriber, because folks identify with you, they trust you, they believe in you, what would you want to ask me? Okay. What would you want to hear if you were there? And so you've come up with a few agenda items for this. I posted an article. There was one this weekend in the Financial Times on Cathie Wood, and there was another one this morning in CNBC. And I felt that Cathie brought up some very good points that are identical, that absolutely confirm our point of view, confirm what we have been saying, what we think, and what we believe is going to unfold over the next coming days, weeks, months, and years. So you're going to do a bit of a PowerPoint on that. So folks, make sure to watch all of this, because I believe this issue of Market Talk has really some very important and pertinent information for us, our strategies, and our stocks. So let's go, Amber, with what you have for me first.
Sure. Well, I'm really looking forward to the Cathie Wood PowerPoint, but the first question I have for you today, Paul, that I think is on a lot of people's minds, even though we are heading toward more EV adoption, people still drive gas-powered vehicles. So I like to, you actually recently tweeted out and reposted this tweet about how California is seeing or will see $7 per gallon gas. And now it's time to really consider buying an EV, given that we are now seeing gas prices hitting $4 a gallon and more, diesel way over $4 per gallon. Do you foresee this being a catalyst in really catapulting the EV buying frenzy, or more people adopting EVs into their lifestyles going forward? And if so, regarding Tesla, which is what we view as the EV leader in auto manufacturing, do you see this as a real boom coming up for Tesla? And where do you see their stock price headed in the future if this is the case?
All right, so there's a lot of different pieces of information in there to unpack. So make sure you keep me on track, Amber, because I can sometimes get a little bit lost in the forest. So number one, let's deal with the facts as they are, which is that crude oil prices last night. I am a watcher of prices through the weekend. I'm always on guard for you, always thinking, always watching, hit a high of 130. It's come back down since then. And Cathie makes this argument in the CNBC article, which is that while in the markets we tend to cheerlead higher prices, and I'm sure people who are long oil and long oil stocks are cheering this, the truth is that high prices come at a price, which is demand destruction, which is that there are a lot of families that cannot afford $4 gas, cannot afford $5 gas or $7 gas. And I have to be completely truthful and say they cannot afford a Tesla EV either. That price is far too high for them. So there is definitely a period of difficulty coming for a number of people in terms of what their choice sets are. Now, offsetting that are equally changes that have manifested themselves as a result of the pandemic, which is that a number of people no longer have to commute to work. They use Zoom, one of our portfolio companies. So as gas prices lift, now a new pressure comes on employers to say, is it really fair to ask you to commute and pay $5 a gallon without maybe offsetting that in some way by giving you perhaps an extra allowance of some kind for this huge increase in price? And the reason for saying that is that there is now an alternative. There are many jobs that you can do remotely. We've proven this. In fact, we've proven that most people are more productive when they work remotely. So this is, once again, an accelerant to change, which is that it offers an alternative. A second one that comes, which is another portfolio company, we own TuSimple, which is one of the leading autonomy companies. And autonomy, for those folks who don't know, it means where there's no one actually driving a truck. TuSimple works in the trucking area. It is instead run by a computer. And there are now actual real plans that are being made for certainly highway sections to be a little bit like railways. In other words, trucks just go on the road and then they deposit themselves at a depot. And from there, you have shorter haul trucks that come and pick up and distribute to more and more local points. This is no longer a fantasy. This is no longer science fiction. This is now in trials in many cities. And I posted an article on Twitter saying that there is now a rush, a land boom going on to find real estate around big cities to actually place these depots. In other words, we're gone beyond technology. People are now buying up land, starting to put up facilities to prepare for a massive boom in freight-based autonomy. That is going to benefit, obviously, TuSimple. There are also a couple of other companies that would benefit from this. And we are now, at the point sort of like when Uber just launched. I mean, that's where we are. And where there was the world of sort of transportation, taxis, if you will, before Uber, and then there is after Uber. And I can tell you that the taxi business was never the same after that. They never got their volumes back. They never got anything back. And that's about to happen again. So once again, we have this split, which is that there is a way of looking at the problems that the crisis, the war is generating. And you can look backwards and see high inflation, high costs, or there are now other choices that you can choose. These choices are innovation. These choices allow you an out, and these choices are also what our companies make, produce, and offer to people. So, and this is one of the other points that Cathie talks about in both of our articles, which is innovation is a genuine answer. These are not ideas anymore like they were in the year 2000. These are actual genuine companies that have hundreds of millions of dollars in sales, are capable of actually scaling up that solution so that if you choose it, they can actually deliver on it. In other words, as we go to implement TuSimple solution, you can put more and more and more trucks on the road, and it will be more efficient in terms of gas usage because A computer drives at a steady speed, safer, gets you there. The gas usage is a lot less. It's, so many different advantages come to mind. So the last one that I'll talk about, which is Tesla. And I would say that the main accelerant is going to be actually to a different part of their business that no one is really thinking about, but Cathie again has talked about this, which is that we're going to fast forward ourselves very rapidly into the robo-taxi business, because the robo-taxi business plummets the cost of per mile transportation. So if you can start to actually implement self-driving cars, where cars, again, rather than sitting in someone's driveway, are implemented, and where a lot of people have access to them, you would then have the same impact as autonomy on personal transportation. And now this would be, again, a different way of seeing an out of high fuel prices. So even as high fuel prices come, you have an innovation that could drive the cost to the person that needs the transportation down. Now, obviously, we're not here yet. Nonetheless, full self-driving at Tesla is now at the 75 or 80% mark, probably even 90%. I have not yet received my new car. I have gotten a date from Tesla. They've promised me that they will deliver on March 16th, and my car is going to come with full self-driving. And I told you this morning, my plan is to drive down to Florida, and hopefully Amber, who is a auto enthusiast, can put it through a bit of a test and see what it feels like. I'm going to trust my new car to Amber, and hopefully we can get some cameras on, and Amber will show you where we are. Certainly, if you go on YouTube, I've seen a Tesla make a left turn across a double road. In other words, left turn where there's cars coming from here and then cars come from here, and make that left turn safely, correctly. If it can do that, that's, to me, in my mind, one of the biggest tests. And this happened in California, where many of the roads are very busy. So robo-taxis, I believe you are going to see, as a result of high gas prices, accelerate, and there will be pressure now on our regulators, who tend to be very conservative, to move regulation along in terms of innovation. They have been sitting on innovation in terms of self-driving, sitting on innovation in terms of Tesla being able to open up their plants. I mean, their Berlin plant has been ready to be opened for 6 months now. Of course, within a week of the Ukraine-Russia crisis, Giga Berlin is now open. And so that kind of regulatory pressure is one more thing that is going to push innovation through. And that has the benefit of course, creating more customers, more clients for our companies, and pushing, accelerating everything forward, both sales, profits in the future, more adoption. So, I mean, the point that we have made, and Cathie makes, which is that crises accelerate innovation, accelerate the adoption of innovation. So there is no immediate impact, of course, to this. It will come, though, as prices stay at this level and the hardships are greater. Now it forces everybody to say, hey, well, we can't instantly produce another 10 million barrels or 20 million barrels or 30 million barrels, but we do have the solution that's available. How can we scale this up? It works, it's safe, it's ready. How can you scale this up? Oftentimes, the obstacles and barriers to that are, truthfully, government laws, regulations. And once people can see that it's safe, it's available, it's cheap, it's convenient, adoption will come very rapidly, sort of like Uber. I mean, there was the world before Uber, there was the world after Uber, where anyone that did not have an app where you could call a car, you simply could not compete. And that's what I believe is going to unfold.
Mm-hmm. Thank you, Paul. I think you answered everything that I needed to know. I don't think, do you have what is your current price target on Tesla? Would you like to share?
We don't issue specific price targets. I believe when we put Tesla into the Profits Unlimited portfolio, I think we were quite modest in terms of what we were looking for. I believe we've surpassed our original price target, which was probably 300 or 400%. When I look at Tesla, I see three different major platforms. The platform that gets the most attention, in my judgment, is now something that is somewhat understood, which is their electric vehicle platform. Right. The Robo taxi platform that I was talking about is almost completely non-understood, not priced in. And I would think that that has something in the range of hundreds of billions of dollars of market capitalization that is not in Tesla at present. Wow. And then there is a third business, which is their solar roof and Powerwall business. And I've mentioned to folks before, I own two of these Powerwalls. Mm-hmm. And so electricity prices are also going up as a result of natural gas prices going up. And truthfully, I actually have almost no impact because I get my power 80-90% from the sun. It's stored in my Powerwall, and then I use it during the day. And this is once again a solution that certainly needs to be cheaper for it to be mainstream. Right. There's certainly no way that the vast majority of people can afford a Powerwall, and I totally understand that. However, on an industrial scale, for industrial users, business users, it's definitely affordable. So those sales will start to pick up a great deal for Tesla. And that is also very, very unpriced in Tesla stock. And that too represents hundreds of billions of dollars. So I would say that, Tesla today is like a $850 billion market capitalization. The market, I believe, will start to look ahead and start to price in robo-taxis as they understand that there's now regulatory pressure to actually push this innovation into the mainstream versus wanting to hold it back. And then second, people also will see that, hey, we probably want to, if we're going to subsidize anything, because we certainly subsidize carbon, fossil fuel, oil and gas, we should perhaps look to subsidize solar panels where people during the day can get a significant amount of their power, especially in all these places where they have massive amounts of sunlight. And then batteries then will start with the industrial side, but that will cause their per unit prices to decline. As you get more and more business users coming, you get scale that cuts the price down. Now the residential market can slowly start to adopt it. Now that is for sure a few years out, but nonetheless on an industrial business scale, for sure, they will invest more and more in batteries. And as you know, we're all in, obviously, on Teslas in the portfolio, and then we have STEM in the portfolio. So these are all solutions that benefit the companies that are sitting in Profits Unlimited.
Perfect. Thank you for clarifying that and adding more information on Tesla. Thank you, Paul. So I'm going to change gears a little bit. And my second question actually pertains to a series of tweets or retweets that you posted from Dylan LeClaire regarding just the overall. Dylan LeClaire actually posted a historical buyback and dividend type chart that showed as a percentage of operating earnings for companies that it's what it's done historically. And I'm actually going to post these tweets on the screen so people can read along, and then I have my question for you, Paul. So Dylan LeClaire actually summarizes that in the 2010s, corporations used easy credit conditions to really engorge an historic debt binge, while buybacks and dividends as a percentage of earnings surpassed 100% on multiple occasions. Companies took advantage of historically cheap money and used these types of financial engineering practices, buybacks, etc., to boost their company's stock prices rather than invest in business operations or research and development, which is really the backbone of today's America 2.0 future for companies investing in research and development. So, quote, Dylan wrote, "This has led corporate debt relative to cash flow to all-time highs. So not only are equity valuations falling due to higher discount rates or the Fed funds plan to ratchet rates higher, but financing costs are rising with historic levels of indebtedness, which just really is a quote unquote death blow. So going forward, this means there will be volatility and lots of it." So Paul, based on this thread, I'd like to know what you are betting on that the Fed will do where monetary policy is concerned, especially with many America 1.0 companies really being so debt laden. And also, if we are to expect a lot more market volatility going forward with our particular stocks, and how will America 2.0 growth stocks fare and why?
Right. Again, a lot to unpack. So keep me on track. All right. I'm just going to say that the reason that is cited for our stocks effectively crashing. I mean, they peak in about February of 2021, and then they sort of hover in a correction range for the next 6 months or so until about September, October, and then they begin a pretty violent crash. And now, from my judgment, can't guarantee it, can't certify it, they seem to have bottomed out. Not every single stock, but for the most part, they bottomed out. And we have some confirmation of that because we read in the CNBC article that ARK Innovation is seeing $1 billion worth of inflows. So that's a great sign that people are seeing that these stocks are at bargain prices and they're coming in to buy. From the perspective, again, of the Fed. So if you go back to, why did our stocks go through that waterfall decline and crash? Well, it comes about as a result of the Fed saying that they no longer believe that inflation is transient and transitory. They think there's some permanent element to it, and that is going to make them want to lift interest rates. And market participants, investors, speculators, took that announcement and ran with it. And they decided that, well, every single announcement around a price increase around oil or anything like that meant that the Fed was going to increase rates more, longer, faster. And at some point in time, we were using various market prediction sort of systems saying that we were going to get 7 straight rate increases. And at some point in time, people were expecting an inter-meeting rate increase, which would be really extraordinary. I mean, extraordinary. It would be something that would be of a crisis of like 2008 or worse level. Then they were also saying we might get 50 basis points in March. Chairman Powell has come on and said, no, none of that's happening. We're going to do 25 basis points in March. And he also said very clearly, there are a lot of things going on. We've got a war going on, which has significant impact on a lot of different things. Obviously, the most visible thing is on the prices of commodities like oil, like wheat. But the other impacts are that, well, these prices are also going to destroy demand. There is going to be a massive substitution effect that is going to happen, whether it be for oil at 130, people are going to choose to try and minimize their use of oil if they can. People that use wheat a great deal are going to look for substitutes that are cheaper, that allow them to keep some kind of a profit margin. From the overall perspective of the macro economy, oil prices act as if like interest rates have been jumped by maybe 50 basis points. It is absolutely going to do what interest rates, if the Federal Reserve had lifted interest rates by, let's say, 0.5%, what would it do? Well, it would subdue consumption. And for sure, if you're paying $4 or $5 every time you have to fill gas, well, you're probably stopping to spend in something else. So it has the effect of essentially lifting interest rates ahead of it. And then when you come to our stocks, well, they have discounted, in other words, priced in as if like 7 interest rates were guaranteed, that like an intermeeting, interest rate hike was guaranteed, that there was going to be 50 basis points, because these stocks have gone from their peak down something like, look at a company like Zoom, down 70 something percent. And it is ironic in a way that like I was reading, of course, the news, and President Zelensky of Ukraine was on with over 200 people, including congressmen, senators, other members of our government. And what were they using? Zoom. In other words, the world's communications runs through this company. If Zoom went down, I suppose there might be another technology that people might trust, but certainly I disbelieve the idea that there's that kind of scale and that kind of connectivity where in a war zone, the president of Ukraine could get on securely and talk to the leadership of our country. And what application, what company did they use? They used Zoom. And Zoom, which at one point certainly traded for 30 something times sales, now trades for 5 or 6 times sales. After going through an extraordinary period during the pandemic where they saw 300% growth in sales, they're now at something like double digits or so. However, what will this current Ukraine-Russia crisis do? Will it perhaps act as a stimulant towards more people accelerating how much work they do using virtual platforms like Zoom? I believe that's definitely going to be the case. So we've seen the impact of perceived interest rate hikes on our stocks completely discounted, in my judgment, in my opinion. Now we're seeing, where the economy is seeing, the potential of high oil prices, high commodity prices. And those things, whether it be interest rate hikes, if the Fed should decide to go forward, is not discounted in anywhere near the magnitude in America 1.0 stocks. So I believe that it really makes the Fed be boxed in. They may want to raise interest rates to address inflation. However, it's kind of being addressed by high commodity prices already, which is going to diminish consumption. So I believe that perhaps they will go through with their 25 basis point increase in March. I believe the commentary that comes out of it is going to be very much that, hey, we're very much on hold. We're going to watch and see how things unfold. We're watching commodity prices. We can see various things weakening. For example, the Michigan Consumer Sentiment Survey is a waterfall decline. In other words, people's psychology in terms of wanting to spend is definitely in decline. Certainly seeing the kinds of horrific pictures we're seeing on television and does not make you want to spend. It makes you, makes your heart heavy, and it will for sure have an impact on housing. We've had a housing boom post the pandemic. We've had interest rates go up to nearly 4% for a 30-year mortgage. That will have an impact. In other words, the economy is going to start to slow as a result of the perceived interest rate hikes that were going to come. Now you've got high commodity prices, and that's going to put pressure on the Federal Reserve to really back away from its very strong previous guidance that it was what it was planning for, to softening it. And that represents support for our stocks, being that, in my judgment, the reason why they've gone down is because a number of hedge funds have gone with that narrative, oh, there's going to be massive interest rate hikes. Even though it's untrue, interest rate hikes mean that, growth stocks need to go down, and they've shorted them. So they will need to come and cover, which will bid them up. And then in a growth scarce world where growth is hard to find, our companies start to become more and more premium priced. That will bring regular buyers into our stocks and start to bid them higher. And eventually they will trade once again at premium prices relative to other stocks. And there's no other set of companies in the market that have those qualities. Our companies, relative to Dylan's tweet, they don't buy back stock. I mean, they're growing too fast. That's something that more mature companies do because they don't have alternatives. Largely, they don't borrow from the bond market. Why? Because bond markets don't like to lend to growth companies because they don't have long-term track records that they can lend into. Many of these companies have only come about in the last 7 or 10 years, so they weren't even around in 2008 to some extent. And they just have had really no opportunity to do these things that all these America 1.0 companies have been doing for a decade plus now and gotten inured to, and where the folks that have been buying these stocks think that dividend increases are a guarantee without understanding that they're coming from debt. They think that stock buybacks are guaranteed without understanding that it comes back from debt. So it's been a terrible time for our stocks. However, I believe we're in the right. I believe we're going to win. When I look at the facts, I am incredibly bullish. I'm incredibly optimistic. I'm incredibly positive. I mean, the facts are all in our favor. The market's definitely going a different way. Nonetheless, the facts are in our favor. And I can tell you from having been in this business 30 years, that's exactly the position you want to be. Because what happens is it's a bit like a rubber band, and then it's going to snap. When it does, the results are going to be so much in your favor, no one's going to believe it. And in hindsight, everyone's like, well, that was a no-brainer. That was so obvious. All you had to do was look at the facts, look at the evidence and what was going on. So I know I went through a lot of different things, but hopefully I got to the answer, the question that you were posing to me.
Yes, you covered everything, Paul, and I really like your stance where you just ended and concluded on being very bullish at this time. And I think it's a great segue into Cathie Wood's recent CNBC interview, where she really honed in on what we believe in and confirmed our beliefs in America 2.0 stock investing. And I'll have these bullet points on the screen. But in her case, as she says, it has been a terrible bear market for innovation. However, if you look from the bottom of the coronavirus to that peak of the ARK Invest Innovation ETF, ARKK, in February of 21, we're up, she says, 358%. And secondly, she states that the firm has seen significant inflows since January 2022. ARK has seen inflows of nearly $1 billion during that period. And ARK Invest, actually investor based, she also mentioned, is averaging down. This is something that we really don't speak about a lot, but she's saying this means that their investors are buying more units of an asset when its price drops. And Ms. Wood states that we are amazed if you average down over time how quickly a strategy can come back above that average. And if we're right, significantly above that average over the next 5 years. And most importantly, she says that innovation is set to be the answer for many of the world's problems. So how do you feel about that, Paul? Is that really?
I 100% agree. And I myself have been buying various ARK Innovation ETFs, ARKK, ARKF, ARKG, ARKQ, and PRNT to get exposure. I mean, I want to go on this ride because, as everyone knows, by contract, I'm not allowed to actually own the stocks. Mm-hmm. And I would prefer to own the stocks because the upside in the stocks is going to be far greater than any ETF. This is from experience. I can tell you that. And then I want to, once again, also point to a tweet where I said that for every backward-looking America 1.0 solution, there's a forward-looking America 2.0 solution. And one of the things that I wanted to bring up was food. Like, I've been reading a lot about wheat and the price of wheat. Mm-hmm. Vertical farming. I mean, this is an innovation, that is ready for a crisis to come and say, hey, adopt me, please adopt me. Prices are lower, productivity is lower, yields are higher than using fertilizers or any other old way of making crops. What about protein? Beyond meat, synthesizing protein. Mm-hmm. For every crisis, for every problem that's out there, you can literally map an innovation strategy that is ready, that is scalable, that we can utilize. Now, they don't have enough scale today. Nonetheless, we're America. I mean, we are the land of innovation. We are the land of ingenuity. We know how to get things done. And I believe that is going to be our answer. And as that happens, these are our stocks. They are going to lift sales, lift revenues, lift profits, and people are going to come and want to own our stocks. Folks, I am very bullish. I am very optimistic. I am very positive. The facts, the evidence, everything is going our way. The stocks will follow. The stocks will follow, and we will make big money. And that's why I want to be in on the ARK Innovation ETFs, because they're the closest thing for me to get access to the stocks that we have across our portfolios. But I can only say this again. We're going to win. We're going to win, and we're going to win big. And I am very BOP.
Well said, Paul, and we're BOP with you. So thank you so much for spending some time with us today and sharing your thoughts and insights. It's really been a privilege and a pleasure. Thank you.
Thank you, Amber. Okay. Stay BOP, folks. Strong hands, strong hands.
Mm-hmm. Thanks again to Paul for joining us on this edition of Market Talk Monday. And if you'd like to take your investing to the next level, check out Paul's True Momentum Stock Research Service. Since its founding in February of 2017, Paul's True Momentum model portfolio has actually annualized returns of 31%, about 31%, and has gained a total return of 302%. And just like Cathie Wood's ARK Invest fund, its return has seen a dip or decline in recent months. But when momentum pours back in to Paul's America 2.0 Fourth Industrial Revolution stocks, the rebound and gains thereafter have the potential to be spectacular. So please make sure you are in and don't miss out. To learn more about Paul's True Momentum trading service, stock trading service, please click the Strong Hands icon right here over my shoulder. So that concludes this week's Market Talk. Thank you so much for watching, everyone. Please remember that you can follow Paul and me on Twitter at Mampilly Guru and at A Lancaster Guru. Also, like the channel. Give us a thumbs up if you like the channel, as it supports the channel. We wish you a wonderful week, a healthy week ahead, and until next time, take care.